Leon, I could say this with a straight face. I mean, he's been doing this. I've been doing this 19 years, and he's been doing longer than me. And he's absolutely the favorite lender that I like to be able to, refer clients to. So
Yeah, coming from you, Frank, that means a lot, actually.
okay,
So.
yeah, and actually, Lee is also lives right across the street from us.
Okay, yeah.
So so what I was going to cover is, talking about the home buying process, because you haven't bought a home before, right?
I've never bought a home before.
That's what I thought. And then just, before, like me and Mary would start, this is kind of what I do sitting down with people is, go over the needs analysis. And I'll let Lee talk a little bit about getting pre-qualified and then how we search for your home, and then a little bit about the escrow process. And then, kind of how I think at some point you gotta get committed to the process too. So, the first thing I always ask is, what are you looking for? What's Laura looking for? And it usually comes down to price. This is the big, price. I want to be in, out in Davis, or I want to be West Sac, or I want to be Fair Oaks, Carmichael. I need at least, 3 bedrooms. Everybody should say I want at least 2 baths. And so we gotta, and then, maybe why is that important to you? And then, the goal is to get help you find that perfect home. So what would you be looking for?
So there's a couple things that I have in my mind. I'm not certain, which one I'll end up with. The first one would be like getting a condo here in Fair Oaks.
Yeah.
There's like a couple different condo complexes that are pretty nice and sort of near the river.
Yeah.
That would be probably the one that I could do the quickest. But I also I'm not opposed to waiting this out for a year and a half just to gather a larger down payment. To really just buy the home that I'd rather stay in for, a very long time. Ideally around here, Fair Oaks, but I'm also not opposed to moving more towards either into El Dorado County or into Placer County. Ideally, I'd like to have at least like half an acre, but even an acre, even better.
Yeah. No, where are you working at? Where's your?
Yeah, so I do contract veterinary work. So I travel all around. So within 1 week, on Mondays, I'm down in San Francisco at a vet clinic down there. I just came from Mill Valley and Marin today.
Oh, nice.
So yeah, the weather was nice.
Nice.
And then on the weekends, I work up here in clinics. So,
okay, so
I travel all around. I work for myself, which I think, is good, but also in buying a home, I can see how it might present some difficulties because I have a lot of write-offs. And so my income, after all my write-offs, my income doesn't look very large. So I'm not sure how that's all going to work.
Well, that's where we're going to get to the next spot. So you're working, then you're an independent contractor. So you get 1099.
Yep.
Okay. So just quickly, now there's just a lot of hyperbole going on with the market. But we're kind of going now into what I'm going to call a normal market. So as a buyer, you're kind of, this is going to be a lot less stressful than it would be like a year ago. Say that, it's just a lot less. So, and at this point, this is where I was going to kind of turn it over to Lee, and he'll talk about, getting pre-qualified, pre-approved. Because if we start looking at homes, I mean, the worst, and I know you're very thoughtful and analytical, so I appreciate that. So you want to know this, but the people that don't. But to me, you want to know kind of 3 numbers. You want to know, okay, if I could buy a $500,000 house or condo, this is how much liquid cash I need, between down payment and total liquid cash, and this is going to be my monthly payment. And you got to have those numbers in your mind, otherwise it'll drive you nuts. So
yeah.
So Lee, I'm gonna stop my share.
All right.
And then I'm going to hit share. Okay, yep. Technology worked again.
Yeah. So trying to, okay, so
There you go.
I'm Lee Hurst, obviously, and we're going to cover these topics right here, just who we are, what we do, the buying versus the renting, the anatomy of a loan payment, what makes up that payment, different types of loans, qualifying, the loan process. So that's really the overview. Some of this you always have to figure out, like, how are you going to choose a lender? Can they provide the best programs for your financial needs? Are they a banker versus a broker? How long have they been in business? What's their reputation? Do they consistently communicate? So these are all the things that I work on as a lender, that I am both a banker and a broker. I'll get into that a little bit more. I've been in business for 29 years. You can look at my Google ratings and stuff like that. I think they're all 5-star. I think one thing that sets me apart is that working with me, you do get my phone number, my cell phone number, to where you can just call or text me 7 days a week. And so you have that constant communication, which, you know, is really important to have that guide and the loan side of things. So there's bankers versus brokers. So I run a branch of a mortgage bank that's out of Roseville. It's a really large bank. It's about the 13th largest in the country. But then I also can broker loans, which means I'm sending your loan package out to a different lender. Like, for example, if you're self-employed and we need to verify your income just on bank deposits, you know, we have sources for that, so I can broker those type of loans out. But most of our loans stay with our bank. That's right out of Roseville, and we get great service, and that's all they do are home loans. And so it's a little bit about bankers versus brokers, but I do both.
Okay.
So there's also the thoughts of buying versus renting. There's some potential for tax deductibility. And in your case, you're probably file a Schedule C, getting 1099s. So you wouldn't be using the standard deduction typically. So you would be writing off your property taxes and mortgage interest. So it's a tax savings. One thing that some people overlook is just the equity that grows over time. And we don't know in the next year or two if we're not going to keep seeing 20% appreciation.
Yeah, definitely.
But over like a 10-year period, it's pretty solid that you're going to get about a 4% appreciation. So if you take 4% of whatever, a $400,000 place per year, that's where people really get ahead and gain wealth. And, you know, that's a big part of being a homeowner. And then obviously you can control improvements. You're not going to get kicked out of your home when you own it, and the pride of ownership. So just over the years, I've just seen that people that buy homes, they're always happy they did it. So just what makes up your mortgage payment? There's the principal and interest, which is your loan payment. The principal is what is paid down on your loan every month. There's your property taxes, and then there's your insurance. And so we call that PITI, principal, interest, taxes, insurance. I always say, yeah, it's a pity you have to make a mortgage payment, but that's how you can kind of remember it.
Yeah.
And there can be other parts that make up that payment, though. So there could be mortgage insurance, depending on what type of loan you do and how much down payment you put. But there's also things like it could require flood insurance. There could be HOA dues, you know, especially if you're buying a condo. There's something called Mello-Roos that increases your property taxes where that's bond money that's set aside for infrastructure. And it's typically on a home that's probably built within the last 20 years. So those are all things that can add to your payment, but it's good to know. And, when you want to know what your total payment is, because you got to know what your total outgo is.
Yeah.
So that's the anatomy of a mortgage payment. And I think Frank said that you're a veteran.
Yeah, veterinarian.
A veterinarian. Okay. I thought he meant vet. So maybe a VA loan, but you're a vet.
Uh-huh.
Veterinarian. Okay.
Yeah.
So we're not looking at VA loans, but
No.
Veteran. I did say vet.
Mm-hmm.
but you were right, and I just took it the wrong way.
Yes.
So there's all these different types of loan. There's conventional loans. They're usually for people that have a little bit more money and have better credit. And then there's the government loans where you don't need as good a credit or as much money. And they both have some advantages and disadvantages. So one of the main things that I do up front is I do an evaluation. I really kind of dig deep. So I really understand your whole situation. And then once I get all those facts, I can plug that situation in to all these different types of loans, because you don't want to become a loan expert and learn all about the guidelines for FHA and conventional USDA.
Yeah.
So, that's one of the first good steps to take, is to really get a handle on where you're at. And it doesn't cost anything, but at least okay, I'm here. Here's where I need to go to get where so then we'll figure out whether it's an FHA loan, or it's probably going to be a conventional or an FHA loan that you're looking at. There are first-time homebuyer programs that, and really the only one that's out there right now is for down payment assistance. They're typically not as good. They're not as favorable on the rates and fees compared to if you can come up with your own down payment. But there are first-time homebuyer programs. And then there's fixed rate and adjustable rate, and you just want to stay away from adjustable rate. Typically you're going to get a 30-year fixed rate loan. So the rate's never going to change. You don't have to worry about, the fluctuation with all the inflation going on and what our rate's going to do. So fixed rate's definitely the way to go.
Yeah.
And so this gets into more of the types of loans. FHA is a 3.5% down payment. You can get gifted funds. They don't really require cash reserves. You can have a 600 credit score and still do okay with that type of loan. And it's government insured. So when I say the insurance, that's that mortgage insurance that anytime you put less than 20% down, there's insurance that protects the bank in case they ever had to foreclose on you. One thing you mentioned about saving and waiting is that I've seen people over the years. So for every $10,000 that you save for down payment, it's only going to change your payment about $60 a month. So a lot of people get caught up that I need 20% down because I don't want to pay mortgage insurance, or I'm just going to save to have a cheaper mortgage. Well, how long does it take you to save $10,000 to save $60 a month? And so, you want to look at that. I'm not saying don't wait and don't save, but we're here to just give you the facts. So,
and Lee, you could break that down, right? Like kind of say, if you save this, with this much down, this would be your payments. Because
we do a snapshot on where the market's at right now based on the rates and how much down you have and where the price range is. The thing that we don't know, the other wild card, are the interest rates. And so if they keep going up, I've had some people wait. Like last year, I had some people, well, no, we're just going to wait to save. And I kind of discouraged it. And, now that rates almost doubled, their affordability's down by, $100,000. And they didn't save $100,000.
Yeah.
And even if they did, they'd be right back where they were. So it's just one of those factors that you have to take into account. I mean, we don't know where rates are going. After they've gone up as much as they have, we're hoping that they kind of settle down. You're going to hear about the Fed raising rates again next month. They're probably going to raise it 0.75%, but that doesn't directly tie into mortgage rates. So what the Fed does, they're really adjusting short-term rates. It's like overnight loans to banks. It does generally affect mortgage rates, but that's really typically built into mortgage rates way before the Fed does any move. But you're going to hear the Fed raising rates next month. And don't think that if they're either probably going to do a half or a 3/4 on the 21st of September. pretty much built into mortgage rates at this point. So
Okay.
just know that won't affect rates, but rates are either going to go up or down a little bit between now and then. And that's the big unknown.
Mhm.
And I always say that you really focus on the place that you want to live and what you can afford on a house payment, because you cannot predict rates and what values are going to do or really anything else. But that's the only thing that you're always left with once you buy, is you have a mortgage payment and you have the house you live in. So you want to make sure those things are solid. And so long you focus on those things, I think it's pretty much always a good time to buy, so long it's a long-term investment.
Yes, I always tell people, as long as you plan on holding that home for at least 7 to 10 years, you're going to weather any ups and downs in the market.
There's never been a 7 to 10 year period where homes didn't go up in value.
Right.
In the long term, they're going to keep going up. And if you just average that 4% appreciation, it's going to be pretty close to accurate over the long term.
Yeah. I was going to say, because when we got into real estate, it was like 2003, and the market was screaming up.
Yeah,
Right?
definitely.
So, but in the 90s, there was a downturn, and we had our house down in San Diego and Ramona, and you just make, I'm just making my payment, right? I was oblivious to whatever the real estate market was, because I wasn't planning on selling. So when I got in real estate, oh yeah, this downturn, remember the downturn of the night? I'm like, I don't know what you guys are talking about, because unless you're, so I've always told people that as long as you buy and think of really ultimately buy and never sell, right? Just buy and never sell that house. If you know what I could buy, I could hang it, this is going to work for me in the next 7 to 10 years, you'll be okay. But let's say you were saying, well, Frank, hey, I may be thinking about moving to Michigan in 2 years, then we'd have another conversation.
Yeah, it's a little iffy if it's a 1 or 2 year hold, because you just don't know what's going to happen in that short term. So just continuing the things that we look at as a lender, we're looking at your credit, your willingness to repay, your income and employment, your assets and savings, and then we're looking at the property. So these are really the things that the lender is looking at to get you qualified. So when you're talking about credit, there's these things that make up your FICO score, which is your credit score. We pull all 3 bureaus. They're going to be different scores than the scores that you're looking at as consumer scores.
Okay.
They use a different credit scoring model, the lenders, and they don't make that accessible to the consumer. But it's a lot of payment history. So if you have late payments, the amount owed is a big part. The percentage of your high balance that you owe on debt is a big makeup of that. The length of time you've had credit, and then if you have new accounts, how long they've been established. So those are all the basic things. And then things like if there's collections or judgments or liens or things like that, they'll affect your credit scores. So this just goes on to say that your score is important. You really need at least a 600 score to have a good chance to qualify. These are some time frames for different loans where you can see if you had a bankruptcy, FHA is only 2 years from a bankruptcy, while conventional's 4 years from a bankruptcy. So there's all these things, and these are the things I'm looking at and making sure that we're headed down a path that you're going to qualify for. And do feel free to stop me as I'm going through any of this stuff and just say, hey, wait, let's spend a little more time on that. So another thing that I do is I help people with their credit. And once we pull the credit, I can do a score modeler that will say, if we do these specific moves, you're going to get this X amount of bump in your credit score, which will help you on the pricing for the rates and fees. So that's another part of the service that I offer. Is I'm not a credit repair guy, but I know a lot about credit, and it's good to get looked at and get advice and make sure that you're as sharp as you can on credit. So for employment, we're typically looking for 2 years in the same line of work. And so this applies to you, the self-employment. Well, we're going to typically look at 2 years of tax returns. But there is a newer thing where we run this online approval, and there's sometimes they'll only want 1 year of tax returns. So let's say if you had a bad 2020, with COVID, and you have 2021 tax returns that look a lot more on your net income on your Schedule C, there's some potential that we can just go off the 2021 tax return as opposed to averaging out 2020 and 2021. These are all the things that we look at up front to make sure what your capabilities are. And there's no pressure to do that. I always say, err on the side of getting information and having me look at everything, do some work on it. If it doesn't work, at least you know exactly where you're at and what you need to do. But, maybe there's a case where, this actually looks better than what I thought. So it's kind of an eye opener. I have some people say, well, I thought the payment was going to be a lot more. And some people said, I thought the payment was going to be a lot less. And so and don't go on the online payment calculators, because they always kind of lowball the payments, and they're not accurate. They don't know how to compute the insurance. And so there's a few things with the qualifying. Now, do you have any questions about that with your specific situation?
Well, let's see. I won't have 2 years of work history. I don't really have questions. I think that I'm seeing sort of how it's calculated. At some point I'll probably will come in and talk with you and see where I'm at and see where I need to get to. So it's like beginning to stimulate the questions that I'll need to think about, and, some of the things that will probably become, an area I have to focus on. Like, I know my credit's excellent. I just bought a new car, so they had to pull my score.
What'd you buy?
I got a new Subaru Outback. They have
Okay.
this wilderness edition that's like lifted and outdoor.
Nice.
Pretty cool.
All right.
Those are great cars.
So I was just going to, this was just spurring a question for me, Lee, is, sometimes I've heard with people that are self-employed, is it worth to, like, if you haven't filed your taxes yet this year, or for next year, you could, to gain your deductions, is that ever worth it, Lee? Because I know Lee almost could be a financial advisor. In other words, I've heard of some people like that are self-employed where they'll go a couple of years where they'll want to show more income so they could qualify for a bigger house.
Yeah, that's actually one of my concerns, because right now I deduct, as much as I can, and
Yes,
it makes my income look.
But as opposed to, I think, Lee, there's you could do,
What I think you're saying is that, so if, for example, if you haven't filed your 2021 tax returns, you could adjust how much you deduct to kind of get that number where you want it to qualify for what you want. Is that where you were going with it?
That's where I was thinking, if that's even worth it.
And I mean, it's potentially an option.
But,
do we want you taking on a payment if those are real deductions that you really only net that much? And is it a payment that you can really afford in your budget? So, we want to look at that and just do the right thing for you. But
and
there's all those options.
And the other thing you were talking about, because you have loan products that are based on deposits, correct?
Right. We do have we call them bank statement loans, and we basically take a year of your deposits in your business account. And we typically, most of the lenders cut that in half for a monthly income. So let's say if you deposit $10,000 a month, they'd say, well, your income's $5,000 a month. They do require a little bit more down payment on those types of loans. Generally, there's still some 10% down loans on that type of loan. Most of them are 20% down, and you're going to pay a little higher rate on that because it's a little riskier loan, because they're not looking and verifying your true income. But there's all those things to look at, and that's what I encourage people. Like, even though it sounds like it might be arduous or a pain, but just like even a 5-minute phone call and an email of some of your tax returns, it can happen pretty quickly just to get it looked at and just kind of just get that feedback. So, but there's a lot of different products out there. So we do go off of debt to income ratios, and what that is, we divide what your total debt is by what we consider your gross income. And so, for example, this person makes $90,000 a year. Their mortgage payment in this example is $2,153. So if you divide the monthly income at $90,000 and divide it by your mortgage payment, that's 28% of your income, which is typically where it's really affordable if you're not above 28%. Then you throw a car payment in there. So this person has a ratio of 35%. So if you add up their mortgage payment plus their minimum payments on debt, divide it by their income, their debt is 35% of their income. And you can go to around 45%, in some cases higher, but that's one of the things that we look at in qualifying our what we call your DTI, or your debt to income ratio.
Okay.
So we're also looking at assets. They do allow for gifted funds. You can get 401k funds. Some loans require cash reserves and some don't. But you're going to have some assets. So some of the loans, like on FHA loans, they're a little pickier on the property condition. And basically they're looking for health and safety items. Like if it's a pre-1978 home and there's peeling paint, that could be an issue because it could contain lead, which is poisonous. If there's health and safety issues like that, or structural issues, then the lenders is evaluating that appraisal for those types of things. So they need to be addressed. So just a quick synopsis of the process that we would go through. We start with a pre-approval. So I actually start with a pre-qualification just based on verbal information, but being self-employed, we're going to need documents to really know what we have. And so we work on that. We get you qualified. And then you start working with Frank to find a home. And by the way, Frank and Mary are probably the best agents I work with. I worked with them for 15 years. They always have the best interests of their buyers in mind. And that's really what you want to look for in both a lender and a real estate agent. It's not about our commission. It's about doing the right thing for the client. And I just wanted to throw that in there, that I'm really impressed and honored that they refer me business and that I get to work with them. So the next thing is that you're working on finding a home. And once you're pre-approved, and Frank will get into this more, you put an offer in, you get an accepted offer. Then there's some initial loan disclosures that go out to you. And then we start processing the loan. We're collecting your homeowner's insurance information. We're doing verification of assets and income and all those things. We're ordering an appraisal. You're doing home inspections. We submit your loan to underwriting to get a final approval with the bank. Once we get that final approval, there's something called a closing disclosure that goes out, and then there's a 3-day wait period from when you sign that. Then you're over here signing your final loan documents. So about 3 days before you get the keys, you'll sign your final loan documents. And then basically we fund your loan about 3 days after that. So that's a really slimline synopsis of the process that we go through on the loan side of things. So these are just the steps again. First thing, you get pre-approved, you shop, and you keep me in the loop on things. I want you to bug me with scenarios and, hey, Lee, what about this home? Can you calculate payments? What if I put this much down? And so we're here for you. We're just here to be a guide through the whole process.
Okay. Yeah.
So that's my side on the loan things. And I don't know if you have any questions about that side of things.
Not yet. I think once we sit down and we start to look at the specifics, then it'll become, then sort of my unique situation and the issues that I'll have to, deal with, like being an independent contractor and sort of my work history as well, having 2 years since I'm a recent graduate of vet school. And so we
would use your schooling as part of that 2-year history on your job. Okay. So probably the question is, you may not have 2 years of tax returns showing self-employed. And that's when we actually have to run an approval, because we get this automated approval that comes back. And about half the time it says we can get by with 1 year of tax returns. The other half of the time, they're requiring 2 years. And so once we get to that step, at least you'll know.
Okay. Yeah.
Okay.
That was awesome. Thank you, Lee.
Yeah, no problem. Yeah.
You want me to shift this back?
Yep. It's time to shift her over to you, Frank.
Okay. Okay. So we talked, we've got this. So, yeah, and what Lee said about, and I always would tell people, no matter what, your interest in finding the right home always comes before our interest to make money, right? So I don't want to be at Raley's and have to duck down the aisle because I got you into the wrong home.
Yeah.
So yeah, the first step is, like I said, getting pre-qualified, getting pre-approved, knowing your budget, being comfortable there. And then, how do we start looking for homes? So I'm going to give you access to what we call, I kind of joke, the keys of the kingdom. It's the multiple listing service, or the MLS.
Yeah.
And that's really the ground truth that feeds all the websites. I mean, there's all sorts of apps, and there's nothing wrong with them. So as real estate agents in residential, when we list a house for sale, we put it on the market, we enter into what's called the multiple listing service, and that allows that information to get shared. So with whether I'm at EXP or my own brokerage or KW or Remax or Century 21 or Lions, all the agents see that home active. So from a consumer point of view, for a seller, it's good, and so it's not, and also it's not like just, hey, I'm just going to show you homes that are listed by, I'm an EXP agent. So, and it is a ground truth. So even though all these other sites, whether it's Zillow, Redfin, Realtor.com, my own website, we all get fed by that multiple listing service. So what I'm going to do is, I'll give you a client portal.
Okay, cool.
When we get closer. So in that client portal, let's say you say, okay, I want, say, Fair Oaks, Carmichael, under this much, I need at least this much, and you'll get access to everything that's available by all the real estate brokers, doesn't matter the company. And then you can go in there, you can reject listings, you can even adjust the portal, So you'll see what every real estate agent appraiser sees. There's a couple other sources. I mean, so for sale by owners, even though, for example, they may not be listed, but I can negotiate a for sale by owner on your behalf. New construction homes, if they're not listed in MLS, but same thing, we could represent you on a new construction purchase too. That's if that, we will know once we get your kind of what you're looking for. The only thing with new construction, I have to be there the very first day you walk into that builder.
Okay.
And then open houses, if you do go to open house, and you decide to work with me and Mary, I would just say, feel free to go open houses, but you'll kind of get bugged by those agents. So just say, oh, I already got, I got an agent I'm working with. So we're gonna, like I said, so we're gonna go for that. What I call it, understand what you want. I'm gonna set you up on a search, and once you find that right home, we make that first offer. So that's what we call the escrow process. So when we write out that very first offer, now it's like 21 pages. It's all DocuSign, and it's so I'll go through it in lots of detail for sure the first time. But I want you to understand that you're really protected as a buyer in several ways. So even though you write that offer, we start escrow, all parties have signed, agreed to all the terms, and there's an initial deposit made, that initial deposit is usually anywhere from about 1% to 3% of the down payment of the cost of the purchase price, and it goes towards your closing costs. That would go towards your initial down payment. So it's not just a deposit. And if you end up not buying the house, you're going to get that deposit back. I've never had a buyer lose deposit. So never. I want to keep that. I've had 2 agents on my listings where their buyer lost their deposit. So it doesn't happen even that often. And both of the time I go, you guys are stupid that this even happened. But but anyways, you're protected in several ways. There's what we call contingencies. There's going to be your ability to inspect. And then there's lots of reports that you're going to have to review. So the contingencies is really, to me, the most important protection. Is once we go and get into this contract, there's lots of moving parts. And all these, there's at least what we call 4 contingencies that are written into the contract, that you have to review all the disclosures, any reports, do an inspection. You still have to get final loan approval. We still got to make sure the house appraises. So these are the typical 4 that are written in there. They're run concurrent in the escrow period. The time period is going to be anywhere from 10 to 21 days, and that's going to be negotiated when we submit the offer. But you have to remove these in writing. Otherwise, they stay in place. So what does that mean? So probably the inspection would be a good example. We're going to write in there, say, on a 30-day escrow, that you're going to have 17 days to do all your inspections. And at the end of the 17 days, the listing agent's going to say, hey, all right, time to remove that contingency in writing. Once you remove that in writing, now the deposit that you made is at risk. So now let's say we get to everything's good. Yep, there's no reason not to remove that. But let's say we have to do it, we do a whole house inspection first, and he says, guys, you probably should do a roof inspection too. So now we got to call for a roof inspection. So we're not going to remove that. We're not going to remove, say, that inspection contingency until you're fully satisfied, right? Same thing with the loan would be the same thing. We're going to get a definite, me and Lee will have several conversations. Yep, Frank, you can remove the loan contingency. So these are all your get out of jail free cards. Disclosure, same thing. Those are usually usually we'll have about 7 days to review stuff that's already given to us. And then of course the appraisal. So not that I want you to write offers that you got to cancel, but it allows you to, if we got to cancel the contract, you can then get your deposit returned. So the downside to this is, okay, at this point, and I'll talk again about being committed. We'll talk about these inspections. You're going to spend some money on doing the inspections. You're going to spend money on the appraisal. So you want to be committed there. So So with inspections, there's a whole host of inspections we can do depending on the property. So we're always going to start with what I call a whole house inspection. Typically, they'll start an inspector's about $350 on up. So bigger homes, they charge more because it just takes longer to do it. And that's typically an inspection you're going to want to pay for yourself. Now, sometimes the seller will maybe the home was on the market and the escrow fell apart and he was able to get a copy of the home inspection. That may save you some money because we can still use the old home inspection if it's pretty recent, but it's kind of up to you.
I probably would go with my own, knowing me. I'd want to.
And that's, you took the words out of my, I mean, otherwise, it's always better to me, you hiring the inspector, not only, it's not so much the written report, you want to hear it out of his mouth.
Mhm.
Right, so. The pest inspection is the one that looks for termites and dry rot.
Mhm.
So older homes, those are usually about $120. A lot of times the seller, if the seller's like now, I always will recommend the seller get this inspection already taken care of.
Mhm.
Roof, if it's to me an older roof over about 10 years. Again, I want to hear what the home inspector says, but a lot of times the seller will already have that done.
Mhm.
And those are done by, those are licensed contractors. So even though the seller paid for it, there's no reason not to accept those.
Mhm.
As we get out here in country properties, the well, so
Mhm.
potability and production, septic, does the septic system work? If, there's an issue with boundaries, or you're not sure where especially on some of these older areas,
Mhm.
we're good, maybe want to at least have not a complete survey, but a surveyor go out there and mark some boundaries. So these are the whole host. But plan on at least, once you're in contract, paying for this one,
Mhm.
plus that you're going to be paying for the appraisal, and the appraisals are. I always tell people between the inspection and the appraisal is probably about $1,000.
Mhm. Mhm.
So now if there's issues, well, these, even who does them can be negotiated, but depending on what we find in the inspection, that's going to open the door for more negotiation. So
Mhm.
ideally, and it's in the contract, you're buying that house as is. It's, so, but for example, when we walk through the house and it's it's 100, and like this weekend, it's going to be 110, is right. We're not going to turn the heater on. Right.
Mhm.
So, but when we do the home inspector, we
Mhm.
have to turn the heater on. We may not even turn on the faucet to see if there's hot water, or so the inspector's going to look for, to me, like health and safety issues first, then structural issues or maintenance issues. So, depending on what we find, we say, okay, we may go back to this house and say, you know what, we need to either get a credit for these or a price reduction, or we need to get them repaired to go on.
Mhm.
But again, going in, we are buying it as is, but you still get a chance to inspect. And let's see. So, again, when I talk about being committed, we want you to find the perfect home. And usually for first time buyers, there's always, maybe something. You may not get everything perfect, but maybe 9
Mhm.
out of 10 perfect.
Mhm. Mhm.
So the costs, like I mentioned before, plan on at least once you're in contract, you could easily spend $1,000 on the home
Mhm.
inspection, the appraisal. So we want to, and that's why I said you want to be committed to that. And then last is the good news is as representing you as a buyer, there's no charge to us because we get paid through the seller.
Mhm.
So we're free to a point.
Mhm.
So I'm about wrapping. That's all I had. Let's get some more questions.
I don't. I'm pretty good.
Okay. Leslie,
Yeah, well, thanks for spending the time with
Yeah, it
us. This
was
is
good.
actually our first go around on doing this, so you were like our guinea pig.
Yeah, you guys did great. I learned a lot actually. So I
Good.
appreciate it.
All right, that's good. Yeah, we were like, man, we may throw a party and no one's going to show up. But then we're like, okay, well, we're going to run through this. But
Well, we went through the information. Like, there really is a lot of stuff to know when doing this. So,
Uh-huh.
but
No, it's very digestible. So you guys did. I mean, I understand it a lot more now. So
good. I mean, think of other questions, and then as you go forward, and then just but you know, you'd be surprised at people that, because I know you're pretty thoughtful, just studious, you do your homework, right? You'd be surprised at people that want to look at homes. They're not even pre-qualified, and they want to drive around and look at homes. It's like, oh, you know, you know, or they'll want me to write, you know, well, let's write off on this one, and then you're scrambling, and it just ends up costing you more money because there's a lot of things that we could do that's going to probably save you money in this process, and
yeah.
You know, the different, as you said, different products, whether it's going to be a conventional or an FHA or so. So
well, just let us know when.
Interested in the USDA as well, because potentially maybe I might use that property as a vet clinic. You know, that's one of my other ideas. But
so basically, with USDA, we got to get the address, and there's a lookup because it has to be a rural area. So pretty much all of Sacramento area, you can't do it. Like Roseville, like none of those areas. But
Lincoln, you can, right?
Man, Lincoln, they've kind of cut that off quite a bit more because it's not really rural anymore. Wheatland, maybe.
Auburn,
parts of Galt. I don't think Auburn is, but just, you know, if you want to throw out an address, you can always text it to me. I can do the lookup, and we can look at maps too to kind of start pinpointing. USDA loans are good loans though.
It's a good loan because it's 0% down.
Oh wow!
Yeah,
and the mortgage insurance is substantially cheaper than most other loans too.
Yeah,
so they're good loans.
They're good loans. But I kind of, you know, I've had them. Like I said, I knew that was going to go away, but there was some zip codes in Lincoln. They were, you know,
we used to do them in Lincoln. Yeah,
I mean, they were like regular neighborhoods, and you could do a USDA loan on it. So that's pretty cool deal. So, all
right, well, just let us know when we can help, Laura. We're here to help.
Yeah, sounds great. I appreciate it, you guys.
All right, thank you.
All right, have a good rest of your evening.
You too. Bye-bye, guys. Bye.